Did you know that the word Zomato comes from the word tomato? Namaste everyone, welcome to our YouTube channel. I am Pooja Sharma. In this video, we are going to discuss about Zomato in detail and also why I am not investing in Zomato IPO. Let's get started. So first, let's get started with the origin story of Zomato. In 2008, two friends Dipinder Goyal and Pankaj Chadda, while working as analysts in Bain & Company, saw that their colleagues consistently demand paper menu or different restaurants to order food. That's when Dipinder thought of converting these restaurant paper menus into a digital app which is far more accessible and easier to use. This idea led to them building a food delivery company in 2008 with the name of Foodie Bay, which went on to become Zomato in the year 2010. Now let us see a summary of their primary business. Zomato's business can be divided into two parts, number one B2C and number two B2B. In the B2C segment, the customers use Zomato's platform to read or write reviews of different restaurants, discover and search for restaurants, upload photos, book tables, make payments, order food while dining out, or even to get the food delivered at their place from different restaurants through their delivery channel. And in this entire process, Zomato earns a fixed commission from the restaurant partners. While in the B2B segment, the restaurants pay a fixed listing charge to Zomato to list their restaurant on the Zomato's app. Zomato has a huge reservoir of market demand data, which they use to analyze which dish is in the most demand at what time of the day and in which area of the city. And this puts them in a huge advantage as they use this data to provide consultation services to restaurants, for which the restaurants have to pay a hefty amount to Zomato. But everything is not as rosy as it looks. Restaurants have alleged in the past and still do that Zomato and Swiggy do not share critical customer data, rather use that data to promote their own cloud kitchens. Anyway, coming back, Zomato has added another dimension in their B2B segment by starting Zomato Hypershore, in which they supply ingredients to the restaurant partners. But they generate majority of their revenue from food delivery and the related commission charged to the restaurant partners for using their platform. Now let us see the risks involved in their business. Number one, no brand loyalty. This is quite simple to understand. Let me explain. Today, if I wish to order a birthday cake online, I will be choosing a platform that offers me the maximum discount. For this very reason, when big brands like Amazon with deeper pockets enter into a market segment like this, customer loyalty isn't something Zomato can be proud of. Moreover, you must understand that Amazon not only has a loyal Prime customer base, but they also understand the delivery business really well. We will be talking more on this in the fourth point. Number two, high competition. According to Red Seer Management Consulting, in India, Zomato is not only competing against other food delivery companies like Amazon or Swiggy, but it's also competing against chain restaurants. Chain restaurants that have their own online delivering platforms like Pizza Hut, McDonald's or Domino's, or cloud kitchens like Rebel Foods that own and operate their own delivery fleet. They're also competing against other companies like Dunzo, which provide food delivery at a much cheaper rate. In addition to this, they're also competing against traditional offline ordering methods like takeaway offerings or telephone-based ordering, or the paper menus that the restaurants distribute to their customers, or even the local dabbawalas in some cities who deliver food regularly on a cheaper rate. Number three, costs will only increase with time. In their red herring prospectus, Zomato has mentioned how their cost is going to increase with time and how their losses will continue given the significant investments expected towards growing their business. As we discussed earlier, to retain the existing customers, to attract new customers, and to even attract new restaurant partners, Zomato has to expend exponentially on their advertising and promotion costs. Moreover, developing new platform features, entering into new markets in India, and even expanding their delivery network will incur a huge cost. Number four, low entry barrier and no switching cost. The barriers to entry in this industry and the cost of switching for the customers is very low. Tomorrow, if Swiggy or Amazon or any other platform for that matter offers more discounts or provide lower costs, the customer wouldn't think twice before switching. Even the restaurant partners can prefer to list on a platform that offers lower commission rate, and in general I think restaurants would like to register on different platforms to maximize their volume of orders. Number 5. Legal cases against NRAI with the risk of possible ban. Since 2018, restaurants have been facing numerous issues with two aggregators, Zomato and Swiggy. Earlier this month, the NRAI, National Restaurant Association of India, complained to CCI, that is Competition Commission of India, that the practices adopted by Zomato and Swiggy have appreciable adverse effects on competition. They have highlighted various issues such as bundling of services, deep discounting, data masking, lack of transparency, and exorbitant commission being charged by these aggregators. And as the news suggests, NRAI may also even come up with its own mobile app in the near future. And there lies a big risk. Because you must realize that Zomato is nothing more than a marketplace. It is dependent on the customers, it is also dependent on the delivery boys, and it's also dependent on the restaurant partners. If tomorrow no restaurant wants to list on Zomato, all the customers will eventually shift to an online marketplace where they can find all their favorite restaurants listed. And that is why, my friend, I'm not investing in Zomato IPO. If you're just investing for the listing gains, go ahead, you can, but I would like to wait till Zomato comes out clean against all the legal disputes and actually starts making profits. Zomato, as you would know, is still a loss-making company. So the fundamental ratios like price to earning ratio or earning per share cannot be applied in their case. I would like to know your views on Zomato. Let me know in the comments if you're investing in Zomato's IPO. If you like this video, hit the like button. Come on, do it.
Okay.
And let the YouTube algorithm know that this content is worth sharing and worth spreading with intellectual people and interesting people like you all. Until next time, namaste, bye bye, and take care.